Hello, everyone. Welcome back. And I will say welcome to my home again. I'm recording from there today. To my right is just a beautiful view of a lake that is not far from the house. So I just couldn't resist on a beautiful spring day having a great conversation with Caleb Sevion of FP Macro, which you would know as Focus Point is the actual name of his company, Focus Point Capital. We've named it FP Macro with Tranquilli Financial Advisor. Caleb is the founder of the company. Glad to have him join us again. So Caleb, welcome aboard again for a good 20-minute discussion about where the world is. Glad to see you again. And again, thank you for being here with us.
Sure.
Yeah, glad to record this and get it out there to everyone that works with Tranquilli Financial Advisor and whomever it is they'd like to share this with. So I promised you that as part of the summer series with all the different investment firms that we work closely with, that I would touch the third rail with you as well. And the third rail being politics, as everyone has heard in the previous couple of recordings, and the impact the current political environment, of course, presidential election year, is having on your thoughts as someone who manages money for clients of Tranquilli Financial Advisor and other advisors. So if you don't mind, give us a few minutes on the candidates, the impact they're having on markets, your thought process of investing during a presidential election year.
Yeah, thanks. I appreciate it. And thanks for having me be a part of this. Well, I mean, obviously, so what's kind of generally been transpiring has been Trump's lead has been building over Biden. Biden had Trump was ahead, and then after State of Union, Biden pulled ahead a little bit of Trump. He received a little boost from the State of Union. He had a very good showing, and since then, Trump's been kind of coming into the lead a little bit more. I think current polls, depending upon whether you're looking at Harvard, Harris, Morningstar, Emerson, have Trump kind of in the lead by kind of 1 to 5 points. When you look at the betting markets, there's Betfair's predicted, Polymarket, how people bet. They all have Trump in the lead by as much as they're actually have Trump in a little bit broader lead. They have kind of 68 points ahead. So Trump is a little bit the front runner right now in the way that's going. And so what has he told us? To some degree, a lot of their policies look very similar with Biden last week. Enacting tariffs against electric vehicles against China. I think in Trump talking about having up to 60% tariffs against China. I think what we can expect to see out of either candidate, if they're elected, is that there's going to be more friction with China in terms of trade. So I think that's pretty unified. I think it's going to be more extreme under Trump. The one thing about tariffs are good and bad. They're being put in place for a reason. The auto tariffs are being put in place for a reason to try to keep China from dumping cheap goods on the United States markets. And that's why tariffs generally are put in place. The other reason they get put in place is because what's generally happened over the last 30 years is that China has pursued a policy of expanding their industrial capacity to the point where they became the factory of the world. To the degree they did that, they degraded the United States willingly, unknowingly, sort of degraded their industrial capacity. And now as we look out at the world from the United States point of view, and what's going on in the world, the question is, can the United States really afford to have their industrial capacity degraded? Can we afford to have everything that we produce that goes into the laptop that you're talking to me on, that I'm talking to you on, being produced in China? If we were to get into some sort of altercation with China, and I'm actually kind of playing around with a piece right now on this, which is related to the way that the United States bankrupt the Soviet Union. There's a great strategy piece on how the United States bankrupt the Soviet Union was we discovered in the late 80s, it used to be the arms race. There was an arms race, and every single year, each country counted their missiles and said, okay, who's got the most missiles? Well, then in the 80s, the United States took a different shift. In the late 70s, 80s, the United States took a different shift on things, and they said, well, what do we have that Russia doesn't have? We both can produce a lot of missiles. What do we have that Russia doesn't have, that the Soviet Union doesn't have? We have technology. So the United States began to focus on their technological advancements of their military. And Russia tried to keep up, but they couldn't keep up. So what ended up happening is they ended up bankrupting Russia, and as a result, or Soviet Union, as a result, the Soviet Union broke up. And so when you look at the world today, if you wanted to take a little bit of one view of what's going on with the world today, is there are altercations that are developing all around the world, whether it's Russia invades Ukraine, whether it's the Middle East, whether it's China and Taiwan, whether it's the Philippines and Taiwan, whether these things are developing. What's ended up happening is the United States is having to split their resources, and they're having to fund all these military operations all over the world against China and Russia, who together, Kissinger, who passed away recently, said the biggest threat to the world peace is if China and Russia ever get together, because Russia has the resources and China has the manpower. And so that together they represent a big problem for the United States, and that's what's happened. And if you look at what's going on in the world, the United States, with Venezuela, threatening to invade their neighbor for oil, the United States is having to fight battles on multiple fronts right now, and we're having to build missiles, we're having to fund other people's military, and what it's doing is it's draining resources out of our economy. And so, from a strategic standpoint, I see what's unfolding right now in the world as similar to what was unfolding to the United States, to the Soviet Union in the 70s and 80s, to try to bankrupt the Soviet Union. So I think what's going on is Russia and China together are colluding to try to bankrupt the United States by creating all these hotspots in the world that the United States has to react to. So I think.
So how do each of the candidates, in your opinion, handle that and the impact it has to markets for us?
Yeah. So you're sorry. Thank you for redirecting me on that. I tend to.
You're good. You're good. That's it.
So I think that what you can see is that under a Trump presidency, he's going to, if he were to win, I think we'd have a more favorable tax policy for businesses, which should benefit businesses, and that would be positive for the stock market. But we would also have potentially a much more stringent policies towards tariffs, and which would be inflationary. That's problematic. So that means higher rates. It means lower taxes. It's difficult to say what that's going to mean. Obviously, if we have to have higher rates, can we then, through the fact that there's sort of tax stimulus, can we still sustain economic momentum as a result of that? I don't think we know the answer to that. I mean, I think we have some idea what it will look like. The investment implications, I think, get a little bit murkier. I think we're going to have to keep on our toes, because I think to the degree that he's also talked about doing things like, doing away with the independence of the Fed, which are, so I mean, there's some tricky things under Trump, and I think we're just going to have to, it makes me happy that we have a strategy like we have, which is that we're constantly measuring what's going on with the economy, because I think under Trump, I think things could go okay. I think you could have growth and probably a little bit higher inflation and growth, or you could have potentially higher inflation, higher rates, and real major slowdown in the economy. But the way that we're going to learn that is we're going to go through it, and we're going to have to adjust the portfolio based on what's going on.
There you go. Adjust. That's my favorite word over the past 4 years and next coming, we'll say, we have to be able to adjust. We have to stay nimble and willing to accept or include different thoughts than we may have right this moment into the portfolio. That doesn't mean we have to do it all. We're not doing it every day, but we're willing to see things differently and implement that in portfolios. Just give me a moment on Biden, since you did talk about Trump. Do you think it's more of the same? And when I say more of the same, I'm not talking politics. I'm talking about investments, what it looks like for the markets. Is it more of the same from the now 3.5 years moving forward, or do you think there's something different in a second term for a president? Well, both would be second term presidents, but in this case, a re-election for Biden.
Yeah, I mean, I think Biden. I think that what's he going to do that he hasn't done already? I mean, he's really gotten the Inflation Reduction Act. He's got the CHIPS Act. He's got these major acts already pushed through that are. I don't anticipate the agendas for pushing like major spending programs through. I don't think are going to be there. I think that that probably the big thing for him will be trying to adjust taxes, which I think is generally not as business friendly to adjust taxes. So I think that puts a little bit of a headwind in front of the economy. But I don't think that's the driving force in the economy, is whether you raise corporate taxes or individual taxes 2 or 3%. I mean, that obviously makes a difference, but ultimately that's not what's going to drive the economy. I think his energy policy is going to continue to try to move resources towards alternative energy means, and I think it'll probably mean he'll continue with this route where he tries to sort of defend U.S. interests against the increased sort of hostility between the Russia and Chinese.
In the world, I get you. Okay.
So I mean, I think it's really more of the same, and I think I think a little bit of a headwind from higher taxes, but I think there's a lot more certainty with the Biden presidency because I think we know what we're going to get with the Trump presidency. I think Trump's more unpredictable, and he likes being unpredictable.
As the wind blows kind of presidency. I
mean, he says that. It's not my words. He says he likes being unpredictable because he likes other world leaders having to guess what he's going to do, because he feels like that type of policy makes it so that other leaders are wary of the United States. And so that's sort of his philosophical way of approaching things. And for better or for worse, that's how he approaches things.
Okay, and we won't share our thoughts of better or worse either candidate. This is purely how does it impact investing. So let's move over to the investment world.
Right and on that note, I mean, I think it's whenever we look at things internally, I mean, our views are to look at policy, not politics. So my remarks aren't for one candidate or another candidate. It's merely just try to analyze our policy, mostly based on what you say.
Yeah, well, and I'll on my end, I say to clients all the time, politics are a constant agitation. So just consider them an agitation, and let's move on and talk about what we need to as it applies to each person. So, and with that in mind, so we're recording in the last few days. We've had Jamie Dimon, J.P. Morgan, Bank of America. I should say, up there, let's say, talking about how he's not buying back his own stock because it's too expensive. And then we get Warren Buffett talking about how Berkshire Hathaway is sitting on 189 billion with a B in cash. And, unfortunately, they just don't have anything to do with it. I just couldn't feel any worse for him. So, to me, what is that message? Because the if you will, headline interpretation is both of them are saying the stock market is overvalued. The cynic in me, the Jersey guy in me, says they're setting themselves up to go buy at a lower price. If knowing their ability to influence markets, they're talking about their own company's stock being too high or having 189 billion in cash that they can't deploy. What are they, in your interpretation, Caleb, what are they really saying to the markets?
Yeah, I mean, they're both, value investors, right? So they're both talking about value and they're both talking about valuations. And like, so we look at, when we look at the markets, we look at liquidity, we look at valuation, we look at economic momentum, we look at technicals, and we look at volatility. What they're speaking of when they're talking about their views is because they both have a value bias, they're talking about valuations. And I think that there's been, there's no question valuations are high. We look at different measures of valuations. We have a valuation component to the models that we run. And what we really find is that valuation does turn into, first of all, valuation is a horrible market timing tool. So, and I think Warren Buffett and Jamie Dimon would tell you that. The fact that it makes them nervous that valuations are high, it makes them nervous, but it doesn't mean that you should react to that because they're not a market timing tool. Now, to the degree that things reach extremes, like they're in the top decile or bottom decile, there is a little bit, especially in the bottom decile, when things get really cheap, and there's an asymmetry to it. When things get really cheap, valuations do matter. But when things get when valuations get pretty expensive, what you find is generally valuations, beget higher valuations, beget higher valuations. And so to say things are expensive, so I'm not going to buy, is sort of a value investor's, value trap. Yeah, they're right. 100%, they're correct. The market will go lower. From what level will it go lower? We don't know the answer to that because I think that the person Ben Bernanke, who used to be chairman of the Fed, I heard him talking once at an event, and he said, "Hey, listen, there's a 15% probability in any given year that the economy will go into recession." We at the Fed, with our 400 PhD economists, have never been able to get really much better at predicting a recession than telling you something like that. So there's a 15% probability probably that we'll have a recession next year. And if not, we'll have it the next year. And if not, we'll have it the next year. So right. Warren Buffett and Jamie Dimon are correct that the prices will go lower during that recession, but from what level? And so I think that it's an important point that the markets generally move higher. In any given year, 8 out of every 10 years, they generally move higher. About 65% of months, they generally move higher. So I think the message there is don't get too pessimistic. Bulls make more money than bears. And that what you need to have, at least from our perspective, is that you need to have a mechanism in place for determining when things are too shaky, and then you step back and you move to the sidelines, you take some risk off the table. But I don't think it's single faceted. I don't think it's just based on valuations.
No. Okay. I think multiple theories in the market. I talk about it all the time. Multiple theories working on money. And if I can just soapbox for a moment, indexing is neither the best or the worst. Active management is neither the best nor the worst. They have their time that they're better than the other. And fitting each of them and different money manager theories into portfolios, in my opinion, is what works over the long term, is because you haven't overcommitted to one method of, well, I'm looking for value and everything is so expensive, I've got to sit on 189 billion in cash, or for someone else, maybe it's 10,000 in cash or whatever number it is, because I'm just so scared to go in. It's so valuable. Well, history says, I think, as you're pointing out, it's always a good time to invest. And for compliance purposes, that doesn't mean specific investment advice for anybody watching this right now. How's that?
Yeah, absolutely. And Warren Buffett's a great example of that, because Warren Buffett, he's sitting on a huge stockpile. He was sitting on a huge cash stockpile last year too, and the market went up while he was sitting on his huge cash stockpile.
Yeah, exactly.
So like I said, eventually he'll be right, but from what level will he be right from? Right? And I think it is, and I'm sympathetic to the view, and you and I talked about this a little bit before we started, of this, this is an extremely confusing time. As I had mentioned to you, I was just reading the transcript of a Paul Krugman, who won the Nobel Prize in 2008, is he writes op-eds in pretty much a lot of the major newspapers, Wall Street Journal, New York Times, Bloomberg, and he said he's fanatically confused right now because
Fanatically confused,
which I just love. I'm going to be using that a lot. And he's a pretty smart guy. And he said, we just don't know whether we're going back to the pre-pandemic economy of 2019, which he says is his baseline. That's what you just have to think about, because you can't just assume the world's changed, or we're moving to a different type of economy where we have higher inflation, higher interest rates, R star, which is the neutral rate of interest rates, is higher. And he's like, I just don't know which it is. He's like, I'm confused. And what you can see is these big factions splitting on either side of either strategists or people within the Fed presidents. I mean, Jamie Dimon is an example of, he's taken a view where he's on one side of that, right? And because the view is there are two separate views, right? One view is that sort of higher for longer and more inflation. The other is we return back to where we were. And Jamie Dimon has taken the view of higher for longer. And if he's right that things are higher for longer, then that's a different world. He's been talking about that. He said rates could go up to 8%. And there's other people who say that too, but there's also people who say on the other side that are saying rates could go back to pre-pandemic levels. And which one do you believe? It happens to be that Jamie Dimon's chief market strategist, Marko Kolanovic, who is one of the last holdout bears on Wall Street. The other big holdout bear was Mike Wilson for Morgan Stanley, who capitulated this week and finally said the market's going higher. So, I mean, there's these views, and there are different sides. I think, but when you look at the investment implications for this, the investment implications get very interesting, right? Because if there's a higher for longer camp, then as long as there's growth associated with that, then markets can continue to move higher. And if there is, if we return to a lower level, if we're able to maintain growth because employment markets stay strong, and consumer spending stays strong, we could have a stronger market. Where it gets tricky is if the labor market deteriorates quicker than people think it's going to deteriorate, and consumer spending dries up, which we saw signs of that this month for the first time last week with retail sales turning negative, and now the housing market is looking like what's happening in the housing market is we're starting to see active listings increase. We're starting to see sales decrease, which are signs of stress in the housing market, and which are indications that the consumer may be starting to feel weaker. Less consumer spending, less willingness to buy real estate, less. These indications create worries, and if that happens, they tend to be self-perpetuating cycles. But again, this just gets back to, you have to be analyzing this information all the time, and then if you see it, like right now, we have been all year, we've been positive on risk assets. We've had above our average allocation to risk assets, but we're evaluating this all the time. If we start to see that change, you start to see our asset allocation shift lower.
All right. Well, and that is a perfect lead in to give us a few minutes on how does Focus Point Capital look at the rest of 2024 from a stock market standpoint. Positive, neutral, negative. Give us your take on the remainder of 2024. Of course, understanding that this is no guarantee. This is just simply Caleb team looking at things, saying we think it is going in what direction?
Yeah, so I guess I'll start out with a short metaphor, which is, what we're trying to do when anybody who's trying to forecast the market, it's sort of like driving a car at night with your headlights on, right? You can only see as far as your headlights will tell you. If it's dark out, you can only see as far as your headlights will tell you. And so what's happened is, people's ability to forecast, the Fed abandoned their ability to forecast and said, we're only going to look at the most recent data and forecast a very short period of time. So the Fed did that. And the reason you've been seeing people drop off, like Mike Wilson from Morgan Stanley drop off, is because they were using traditional measures to forecast that, like they had their headlights that they felt like it always worked in the past. They could always put their headlights on and see what was going to happen. And then they realize, what people realize is after the pandemic, a thick fog rolled in. And so now we're driving, all of us who are market strategists and economists, we're driving our cars like we'd always driven our cars before, where we're looking out the front. We've got our tools that give us our headlights so we can forecast out like we're going to see. And then this thick fog rolled in. And now we're having to say, well, we can't really forecast very far because our headlights don't work anymore. We think they're going to start working again at some point. Like, we can see they're working. They look like they're on, but we just can't see in front of the car anymore. And so for the Fed, that meant, hey, we're just going to look at the the Fed says we're data dependent. So when people say they're data dependent, that's what they mean. Their headlights don't work anymore, right? So to some degree, this sort of plays right into the way we manage assets. The way we manage assets is we look at 28 different factors, and we look to see how those factors are evolving. And those factors, we have algorithms that tell us, like, if the factor is evolving a certain way, what does that tell us about returns 1 month and 3 months out? So we don't look 6 months, 12 months, 24 months out. We think that a lot of things could happen. You have to have a view of that. You have to have a thematic view, because that helps you determine how you're going to allocate capital into which sectors, and because there are tailwind, you want to allocate money into place where the currents are flowing. But more importantly, what we do is we're just looking at the most recent. We're looking. Our headlights don't go very far, so we're constantly.
All right. Well, then give us to the end of 2024.
They don't really give us to the end of 2024.
Headlight metaphor. That's good.
Yeah, I think for the next one.
Yeah,
so for the next 1 to 3 months, in which is how our portfolio is positioned, I see that our portfolio we have above average risk weightings, and
meaning stock.
So we have above average risk weightings in equities. Where we're positioned, we have money in the U.S. We see more and more opportunities lower in market cap. We have money in mid caps. We've increased our allocation to international. We've liked Japan for years. It's done very well for us, and it's continued to do well. But it'll be interesting to see if we may actually move money out of Japan later this year, because I think if the currency moves, it moves in the other direction. We've done very well in that trade. But there's a general trend in our portfolio, which is to become more diversified. So we're more diversified. Instead of very country-specific bets, we're going, broad international. We think emerging markets could do well if the Fed cuts rates, because I think their currencies are being artificially held too strong by the fact that they've had to have strong currencies, because they can't let their currencies depreciate against the dollar. So I think emerging markets could do well if we cut rates, and I think we will likely cut rates. So we've increased our exposures there. I think gold continues. We've had the highest exposures to gold over the last year and a half that we've ever had in our portfolio. It's about 4.5% of our portfolio right now. I think that could continue to do well. So I think the environment for risk assets for now is very good. And I think as long as as far as our headlights can show us, and I think that could change by the middle of summer, could change by the fall. And
we'll leave it there.
We'll be adjusting the portfolio.
Yeah, well, and that's your role as part of Tranquilli Financial Advisor and working with clients. So Caleb, thank you. We took about 5 extra minutes there. Caleb Sevian, Focus Point founder, chief investment officer, and much appreciated by everybody here for having a conversation with us.
Thank you. I appreciate it very much.
You bet. Yeah, of course.